Good afternoon, everybody. I want to welcome each and every one of you to Trading Index Options today. I'm Connie Hill, sitting in for Ben Watson. Ben is on some business for the company, I think down in the South. So if you happen to be around those areas, you might be running into Ben, possibly so. I'm happy you joined me here today. I want to talk a little bit today about trading index options. And those of you that have been to this class, I want you to answer my question. Actually, you don't have to have been to this class either, but why are index options so popular to trade? Why do you think, in your mind, might be one of the reasons index options are so popular to trade? Okay, we're going to talk about that a little bit here today. I am joined in the chat by Barb Armstrong. I'm happy Barb is here. She's a fellow coach and friend. She's a great veteran of the markets. I know lots of you love to go to Barb's classes. And so we're happy that she's here because she's going to help me field maybe some questions I cannot quite get to, okay? Or some things maybe a little bit off topic, but we'll both keep our eye on the chat. If you're listening to this and on the recording, when you have questions, since you don't have a chat available, go ahead and put them in the comments section of YouTube, because we go back and review those comments and questions throughout the trading day so you can get your questions answered too. Ooh, some of you are typing in some excellent reasons why index options trading might be so popular. Now, I hope you're following us as coaches on X. I'm Connie Hill, CS. Barb is Barb Armstrong, CS, and we'll post educational content, things we're noticing out in the market, maybe specific invitations to you. So if you follow along, you'll get in on all those little nuggets throughout the trading day. Well, we're going to go ahead. We're going to start our disclosures, but before I show you the first disclosure, I've got to show you a flash of something that I want you to have in your mind's eye for when I bring it up again in about 5 minutes, okay? So this is going to be exciting. I'm not going to tell you what it is exactly. I'm just going to show it to you for about 5 seconds, okay? 1, 2, 3, 4, 5. That's it. Okay, just wanted you to have it in your mind's eye. Let's go through our disclosures. What we talk about today is intended for educational and informational purposes only. It shouldn't be considered a recommendation. Investment involves risk, including the loss of principal. Past performance is no guarantee of future results. Dividends are not guaranteed. When we talk about specific symbols, keep in mind they're for illustrative purposes only and shouldn't be considered a recommendation. Equity and index options carry a high level of risk and are not suitable for all investors. The ones that we're going to be dealing with today are called American style options. Oh, I take that back. We're going to be working with European options, which are different than American options. American options can be assigned early. European style options cannot. And so these indexes that we talk about trading, that's one of the things is they will not be assigned to you early. And that actually is one of the bonuses, all right, of the draws of people using the index options. When we're talking about probabilities today, we're going to keep in mind those are theoretical in nature. They're never guaranteed. I thought I had one more little slide here. I guess I don't have another slide. We'll call it that's it. All right. In our class, we're going to just take a quick look at the market. It's got another hour before it closes. I want to see just kind of where it's sizing up to be. Not that that makes a huge difference in what we're going to do, but just so that we are aware of that and talk about various strategies that we might use with index option trading. And we're going to be looking at several examples. All right. So there's the one I wanted. Yeah, here we go. Typically in this class, we will do a lot of verticals, iron condors, butterflies, and hedging. Today, we're really going to be focusing more so on credit spreads, so spread verticals. And you combine a bullish one and a bearish one together, they are an iron condor. So that's kind of where our focus is going to be here for a little bit. Now, going back to my initial question about why people are just drawn to these index options. So we've got some possibilities here. Liquidity, says Chris, absolutely. Michael, same thing, liquidity, lower IV, cash settlement, says Paul. Yeah, these European style are cash settled, and can't be assigned early on it. Jay Richardson says, because they're European style and very liquid. Okay, you're hitting a couple of those all together. Martin says, tax advantage, tax benefit. Can't really go into tax implications, but that might be a good thing for you to ask out into your internet search engines. All right. I like your answers. Oh no, Greg, you took a screenshot. Oh, Sharon. Oh my goodness. Yeah, we are going to talk about that. I will say I am the artist in that picture. Yes, those are my vast art skills that I'm showing to you, because I'll be showing you another picture later, and I just want you to have an idea of the level of my skill, which is not as high as my sister's. All right. Let's do this. I'm going to start out here. We're going to hop on over to Thinkorswim. I'm going to show you two trades that I put on today in preparation for our class about an hour and a half ago. No, yeah, about an hour and a half ago. Okay. We did, you didn't know you did this with me, but we did in our class account. We put on two spreads, and I put on a call short vertical and a put short vertical right here. I did not choose today as the expiration. I chose tomorrow as the date of expiration, simply because we only have about an hour left in the market, and I wanted there to be hopefully a little bit more movement than what we might have only seen on one option that expires in an hour. Okay. Let's go here. How much did we get in a credit? All right, on this call spread, you can see we brought in $1.90, and the value of that spread now is down. It's been flipping around here between 150 and 140. So we're up maybe 40, 50 points on this particular spread. Nice. That's $40 per contract. I just did the one contract, but you'd size this to your account. How about on the put side of things? On the put side of things, this one we did not bring in as much of a credit. We only brought in $1.20. I will tell you, both of those spreads, the strike price sold was a 30 delta on both of them. Okay. The put spread just didn't yield quite as much. Maybe there's some more risk to the downside of things, right? It's now worth $1.45, so we're down on that a little bit. So they're almost offsetting here. A $40 gain, a $35 loss. They're kind of offsetting with each other. But the one thing I want you to notice is the time decay element. So in an hour and a half, we've got a little bit of time decaying. And we're going to check back on this throughout our class here today. So I'm going to put over in here, I wrote out what the spread was on the call side that we got at $1.90 on. It is now down to 150. And I'm going to write this value down here. This one is now up to $1.50. Okay, so one's going the right way, one's going the wrong way. They're both about $1.50. Okay, so there has some time decayed. More so on the call option side is it more evident. But there has been time decay on the put side, but it's just not as noticeable because what? Probably because the index has done what? Maybe gone down instead of up. Let's take a quick look here. Right now, down about 0.32% on the SPX. I think at the time that I did those trades, I think we were only down 0.2%. So market has dropped a little bit since I put on those two vertical spreads. All right. So Andy says, hey, is that an iron condor? Technically it is. When we combine a credit spread that's a put and a credit spread that's a call, yeah, it's an iron condor. Absolutely. You can put them on together. You can leg into them together. You can treat them as separate trades if you want. In fact, many times in an iron condor, you will manage it many times as separate legs, and you'll be getting out of the spreads at different times. So, yeah. All right, Ricebird, you said you cannot even draw a stick. Well, you could see I could draw a stick, right? All right, so another flash of a quick picture here. And I'm going to bring in something that you see with Ben every week. Okay. You see an XPX graph with a MACD on this side, kind of maybe looking for divergences, things of that nature. On the right-hand side, we have implied volatility, which has kind of been going up recently, right? The price of oil spiking over the weekend and the volatility it's introduced to the markets. And today, yeah, we can see the market's pulling back a little bit. This is what we call our probability of expiring cone. If you're not familiar with getting that on your screen, just type in prob. That's all you need to go, and then you'll get the probability of expiring cone. Now, many of you, because you've been to Ben's classes a lot, you're like, I know what that is. I do that on my charts and use it all the time. But there might be some people who are not as familiar with it, okay? All right, enter my drawing skills. All right, let's head on back here. So those of you that were here early, you got a sneak peek at my horse drawing. I'll just tell you truthfully, my sister just above me is a great artist. I mean, I think all the creative talent in our family went to her hands and her mind. Maybe not all of it, but let's say 80%, okay? 1 year for Christmas, we rotate sibling presents. Still, it's kind of a fun thing. And for 1 year for Christmas, she drew, or painted rather, a beautiful picture of our sister riding her favorite horse doing barrel racing. And it's awesome. It's a great picture. Well, the next year, it was my turn to have that sister. And I thought, I can do as good as big sister can, right? Little sister can do anything big sister can do. And so that was my attempt to replicate anything even close to what my sister did. But as you can see and imagine, hers was probably significantly better. But you can see I could do straight lines pretty well. I can do kind of scrawny bodies pretty well. And if you want to look thinner on a horse, you just ask me to paint it for you, okay? Because look how thin my sister looks there. She's probably going to blow away if the horse even bucks a little bit. All right. Those are my drawing skills. We're going to hop over here to Excel, and I'm going, or not Excel, a blank sheet, and I'm going to draw on the screen for you. All right. Now, don't expect too much of my drawing. Remember, I just show you why. So I'm going to draw a bell-shaped curve. Hey, come on, pen. Oh my goodness, is that pen not going to work for me? What happened? Let's change a setting here. No. Oh, I'm going to be very annoyed if I cannot draw. Oh, I'm not being able to draw. I just drew a second ago and it worked just fine. Let me close my drawing tool real quick and see if I can reopen it and have it be successful. All right, so producer in my ear, always helping us out, said maybe if I point on this dry icon or dry menu, it'll allow me to, but I might, yeah, if that, I'm going to try this tool. Oh, this is even so much better for an unskilled artist. Okay, we're going to try this drawing tool if it'll let me. Let's see. Maybe I have to hit add. I don't know this software actually to do that. I like ink to do math. I don't think that's the right button. Okay, let me try my drawing tools one more time. Okay, you're just going to have to get a visual here of what I can't really paint. Maybe if I hit insert first. Insert a shape. I'm going to use this shape. This shape might help us a little bit, okay? Pretend that shape, oh, now it's going to let me, is a bell-shaped curve. Let me take this down a little bit. And a bell-shaped curve, you'll have to go back to your math class from years ago. And I'm going to see if it'll now let me draw. Now that that's in there. No, that's not going to. A bell-shaped curve kind of looks like this, but at the bottom of it, it kind of flares out a little bit and it gets a little bit wider. Okay, so imagine these sides are out a little bit more. And then what we do with the bell-shaped curve is we figure out where the mean is, and the mean is essentially the middle point. And so we have the middle point running down through here. So imagine I've got a vertical line, completely vertical here, that separates the two sides. Well, a decent amount away from that mean we call one standard deviation. And it's about 68%. And what it represents is the data points, and whatever the data is that we're looking at, the majority of the points are going to fall within that 68% span. So it's like 35 on one side, I should say 34 on one side, 34 on the other side, okay, or where the data points are going to fall. Well, we can go out a little bit further on our bell-shaped curve so that we're almost out to the end. Okay, not quite, but almost. So imagine if I drew a line about right here and about right here, then the additional data points would be encompassed in there, and that's about 95% of the data points. And we would call that 2 standard deviations. Okay, now, unfortunately, my drawing did not work for you today, but I hope that you at least have that visual. And then what we're going to do is we're going to tip it on its side. And when we tip it on its side, it's that probability of expiring cone. So as we come back here, we come back to our charts. Just imagine, oh, this is what Connie was trying to draw, how it flares out on the side. Okay, and this is our bell-shaped curve, essentially. And it's letting us know what the probability of the prices of expiring, kind of what the probabilities might be, meaning we have some wide points out here, 73.20, 62.45. Well, yeah, after a bit of time, it is possible that maybe the SPX will be out to those extremes. But that would be, you know, date at the bottom is like the middle of April, the 20th of April. But right now, we would not really expect that much movement when we're just really at the top of this cone. Okay, hopefully you've seen a probability cone or a bell-shaped curve so that you can relate to what I'm saying here. Okay, so what do we want to do with this probability of expiring cone? Well, for our credit spreads, we would like to place them at a place where they're not expected to expire, meaning in here, it's expected to be in this range. One thing I want to show you on the probability cone is if we come to our edit studies, and I'm going to go to the gear, look at our settings here. And I want to show you, this is a probability for 30 days. The probability range is set at 68. That means 1 standard deviation. So 34% on the left side or the right side and 34% on the left side. Okay, sums up to about 68%. So that cone over time spreads out and begins to encompass more than 68%. All right. Very good. I'm glad you guys use it. Some of you are saying you use it often. Yeah. Oh, Rita, you can be my favorite person of the day. Rita says that I colored very well too. Well, Rita, thank you. You get the gold star today. All right. What does this have to do with trading index options? Well, we're working with probabilities mostly with index options. We're not exactly concerned today if the market is down a little bit or up a little bit, but we are interested in trend. Now, I believe in Ben's class here, I think the simple moving average he uses here, I forgot about checking this one. I'm thinking it's the 200-day moving average. And this one is only on a 30 moving average. So let's change it to 200 days. If I'm wrong, those of you that come here religiously, tell me that if it's not 200, I'll change it. Okay, So if the SPX is above this 200-day moving average, then typically he'll put on a bullish spread. If it is below this 200-day moving average, well, one thing we can count on is that means that it's been going down, and we would do a bearish spread. So we would do a bearish, which would be a short call vertical, but he will only pick one. Okay, he's going to go with how the trend of the market in this case is essentially going. And that 200-day moving average representing kind of that long-term trend. Yeah. All right. You guys are telling me, yeah, you're thinking that it's the 200-day moving average. Thank you. So 68%, Alexander Haddo, is the one standard deviation. Okay. And then the 95% is the two standard deviation. So if you're like, okay, 95% of the data points are going to be within two standard deviations, then it's most of the body of the inside of that bell-shaped curve. Okay, there's just like 2.5% off to either side. Okay, very good. Oh, Kelly thinks he might be using the 50. Well, should I throw in the 50 and make sure we're above that as well? So we know we're above the 200. If it's the 50, does anybody else have a guess? Here, we'll just test what Kelly said here. All right, 50. And let's see if it's above or below. Oh, if it's below, we would go on the bearish side. If we're using the 50, I really thought it was the 200, so I'm going to stick with the 200, okay? Eric thinks it's the 200 as well. Oh, Michael does as well. Okay, because of that, I'm going to go back to what I initially thought it was, 200, although we're going to get off of it. It's not going to matter so much. All right, here we go. So it is above, so we would consider doing the bullish trade. Now, a trade Ben does in his class every single week. And if you don't learn anything else from this class, you will learn how to do this trade every single week on the SPX. And what he's really demonstrating with that is a systematic approach to try. You can consider trying to do it with these credit spreads. Whether, if it's bullish, which this is above the 200, so we're going to do the bullish one, which would be a short put vertical. And we get in at 14 days out, and we close the trade. When we meet again here in our class 7 days later, we absolutely, positively, without an exception, will always close down that trade, whether he's up on the trade or not. Now, some of you may have done the trade with Ben last week on the SPX. If you did, your numbers the numbers I'm going to pull up here should be familiar. All right. So what was the trade from last week? Let's come over here to the trade tab. Get rid of that. And the trade that Ben put on, because I went back and checked on the video, make sure I had it right, is he put on, where did my notes go? He put on the March 18 expiration, which is last week. It was 14 days out. Now it's 7 days out. And he put on 6620 and 6600 short put vertical. So 6620 was his short leg. So I'm going to say sell vertical. It's going to grab the 6615, which we're just going to change. And we're going to change that to the 6600. He spread it out by 20 bucks. Okay. How much is that spread worth now? And what did he pay for it initially? Or well, not pay for it, but receive as a credit. He received as a credit $2.45. Okay. Does that mean the spread is doing what we expected it to do? Does that mean we're getting a lot of time decay on it, which shorter dated options, we should get a lot of time decay, 14 days out, 7 days out, 4 days out, whatever, right? We know that ice cube melts so much more quickly, that time decay really kicks in the closer we get to options expiration date. Well, it hasn't done exactly what we would have wanted it to do. Well, we kind of saw what the SPX was doing. It's kind of been down. If we go back to our chart and we say, where was it 5 days ago on the 4th of March, which was right here, about our class time, it was probably near maybe the top of that candle. Yeah, it's certainly gone lower, and right now is lower than where it was that we got in. And so in that situation, time decay is going to be happening, but if it's not the direction that the SPX is going, then we're going to be hurt by it. So in this scenario, yeah, we would be down on that trade. All right, so Ben's absolute rule is, doesn't matter if you're behind or not, you get out of the trade today during our class. Okay, so if I did have that trade on, which I don't, but if I did, we would be closing it down. We'd be having a little bit of a loss here. We would have in the neighborhood of about, if we got 245 and we have to buy it back, was that $4? It was jumping around in there. So maybe about a 155 loss. Now, taking a loss never feels good, but taking a small loss feels a lot better than taking something near a max loss or at a max loss, right? We want to avoid those scenarios as much as possible. And that's part of the reason for exiting the trade right now. But then Ben always puts a brand new trade on, doesn't he? Let's do this, minimize this. We've gone a few minutes into our class, so we're going to go check the time decay of that option, and we're going to put on our new trade. All right, let's see here. I'm going to open this up. Last time we checked, our 190 credit on the call spread was down to $1.50. Let's see where it is now. Oh, it's still at $1.50, $1.55. So kind of just hanging in the same spot. Market hasn't dropped too much. And this one, we got $1.24. Okay, now we're only down 0.25, 0.20 on it. It's very similar price. This one's 145 now. We'll go with 145. It was down to 140, but we'll just go with that. And the other one is still down about 150. Okay, so I just want to track that. We have a chance to do it again before we close up shop here. And we're getting closer to the closing bell. We would expect maybe that time decay to wrap up. Now, I've also, before we put our trade on, I also wanted to show you something that those of you that are new to maybe index options might not necessarily be aware of. On my option chain, and I'm going to come to the options that expire today, okay? On my option chain, and let's kind of come down here near the money. These options today, at the beginning of the day, the open interest is in this column. Say, we'll just look at the calls here, but it's the same thing on the put side, okay? This was the open interest. Here is the volume, which means today's activity. Can you see there are just thousands and thousands of contracts here compared to where it started out first thing this morning? Why would so many contracts be here? Why are so many of them taking place immediately, this day, right now? Why so many? You can see the same thing over here on the put, 62, 55, 99. Whereas in the morning, they just had, a few hundred or 1,500, 2,000. Do you suppose tomorrow's contracts look similar? Okay. You can just answer that question to yourself, whatever it is you think, yes or no. And let's scroll down to where the at the money options are. They're not quite as much as what we're seeing in those initial options that expire today, but we're starting to see several thousand. They're starting to build. And are they building in the money or out of the money? Those values, this volume is being generated out of the money. Can we presume then that people are quite interested in selling the options as opposed to buying the options? Now, there's always going to be that other side, the other person taking the other side of the trade, right? If we sell something, the market's going to buy it from us. That's the market's, what the markets do, right? Yeah. I'm going to say, and I should say typically buy it. I can't promise that in every single scenario they will, but generally speaking, that's what our markets do. Okay, some of you have keyed in here on the buzzword, which it's called 0 days to expiration options. And yes, people that are sellers can get kind of excited about that. Now, it doesn't build this kind of volume 3 weeks out or 2 weeks out. It really comes in the last part of the life of the option. Okay. And so what would we expect tomorrow? Well, tomorrow we'll expect that these open interest numbers probably are a little greater, but we would expect to see lots of volume here again tomorrow, probably starting right when the market opens. Okay. Yeah, you guys got it. Yes, I am happy to share the chart with you. Anytime we share a script with you, remember, it's never guaranteed as to accuracy or timing. And I think that's what you're wanting there. You want me to share the script. Maybe tell me exactly what script you want me to share. Okay, I'm thinking you meant of the chart, but maybe it's not. But maybe some of you would like this because this is what Ben's going to look at every week and what we're going to use for our trade setup here. Let's go. I'll show the grid. And I'm going to call this index options class. And then I'm going to put 2. I like to name mine so I know how many panes we're looking at or how many grids. So let me go ahead and hit share. Those of you that are here in the class live, I'm going to throw that in the chat so you have access to that. And then those of you that are listening to this on a recording, just real quickly, I'll throw it in a text box here. We'll put that on the screen. Go ahead and hit freeze, or pause rather, so that you can write down the script. Really, you can grab the whole thing, or you can start with this exclamation point, grab those 9 characters. It is cap sensitive. And so it has to be exactly. I'm going to guess this character here is a capital O as opposed to a 0. A 0 typically is a little bit more oval looking, and then the capital O is a little bit rounder. Okay, so that's one you'll have to maybe guess at if you're just trying to write it down. But what would we do with it? Come to setup, open shared items, pop in the formula, hit preview, and it brings up what I called it. You could change that if you wanted, I guess. Not on this screen, but the next one, okay? And then you'd hit import, then you have it. Now, I'm not going to bring it in again because I don't like to have duplications of things. Just keeps my charts cleaner if I don't do that. But that's what you would do with that, okay? All right, so some of you have it. All right, well, what about today? What would Ben set up today in our class? He'd set up another credit spread, okay? Because this is a systematic approach that we're teaching. It doesn't mean this is the only approach. It doesn't mean this is the best approach, but it's hopefully training you to develop habits of patterns that you can repeat. Okay, the process that you can just repeat. And I would encourage all of you to start paper trading it, especially if you're like, I'm kind of scared of these options. No, just go in your paper money account, right? That's the place to practice. That's the great place to make mistakes. Now, what we want to do is we want to sell a credit spread that is not in our probability cone. Okay, so what do we need to do? We need to go out about 14 days, and I'm going to change the drawing tool here to this little icon. Kind of looks like, I don't know, a circle and a vertical line. Maybe it looks like a plate and a knife. I don't know what it looks like, okay? Or it's a curly Q, I don't know. We're just going to select on that, and then we're going to go out 14 days ahead of time because the options that we want to sell are going to be 14 days out, okay, so that we will close them next week. Well, that date should be March 25th, Ooh, I went pretty close. I went right to March 26th, but March 25th is the day that we really want. Okay, so I am going to take that line. I'm looking at the top to see where the date is. I'm just going to kind of move the line down, go back to the 25th, and then I'm going to anchor it in place. So this line represents what those boundaries are, what the probabilities are for that 68% of the data points, that in 2 weeks, we would say, hey, it's possible. It could be up here as high as, that looks like 7,088 and 6453. Okay, that's what we're looking at here. Well, because we're going to go bullish on this, because it's above the 200-day moving average, if you wanted to use a different moving average for how you want to test this out, you could do that. You could change it back to the 50 that we looked at earlier. You could use 100. But because this is a system, I'm just going to follow the system rules. Okay. So out in this area, we would not expect the market to be there given the information we have today, the volatility we have today. But could it be clear out here and way down here? I mean, it could be, right? Because we know anything can happen in a market, but it's just that the probabilities don't favor it being this low or this high in that short period of time. So I'm going to come along here, and I think our strike prices are going to be in $10 increments. So I'm going to find what I think is probably the closest to that, and being right on the line, and I think that's about 7,100 even, that we could sell on a bear call spread if we were going to play that side too and do the iron condor. And then down here, I'm just looking, where does that golden bar intersect the purple line? And that looks like about 64.53. So we're going to go 64. We're just going to go a tiny bit outside of that. We're going to go 64.50. Okay. That's where we're going to structure the trade to be. We want it to be beyond that point. Okay. How much beyond that point? Well, we'll decide here. Okay. So 64.50, I should write in here and say or less. Okay. For our point that we're going to choose. Okay. Let's see. Rita says, what is the advantage of using the cone graph instead of the delta value to see the probability of it happening? We could go compare. Trying to think how that might work. I mean, let's look at it, because I have that probability of expiring out of the money as a column in my chart, or in my options grid here. So we'll look at that. So we're going to go 14 days out. That's that March 25th. We want to be beyond 64.50 on that put. So 64.50 is right here. So we want to sell beyond it. Okay. Now, if we look here, and let's just go say with 64.30. That is beyond where the arc is, right? That's where we don't expect it to be. Anything lower than that, or I should say down lower on the options chain, is where we might expect it to be. Okay, so 64.50. I said 64.40. It was really 64.50. So let's do 64.40. Okay. Probability here is 81% that option would expire out of the money. I think, Rita, you can use those together. You might not know that this 81% number is not within the standard deviation. Just by looking at it, right? Well, is this in the money? Is this one in the money? Is it within the standard deviation? We really don't know for sure without graphics, but you could maybe use that as an additional reference point. So we're going to put on here 64.40. And Ben likes to sell these 20 strikes a the 20 strikes wide. So we'll just kind of come up here. So that would be our 64.20. It's got 64.30 in there, but we're just going to change it to 64.20 right there. We're going to bring it in about a $2.5 or $2.3 credit. Okay. As I've observed in the chat, because I'm in here frequently, that is pretty dang in the ballpark of every week about the premium that we're selling. Now, could you go further out? Could you say, I want to be way outside the cone? You certainly could, right? Say you wanted to sell 64.40 or 64.25, you certainly could do that and run the numbers. And then just see, where is your comfort zone outside of the cone? Do you want to be just barely outside? Do you want to be further outside? And if it's further outside, does it give you enough of a reward to reward you for doing that? Okay, I'll go ahead. I'm going to put this one on. I think Ben will be here next week, but just in case he's not, we're going to throw that in our weekly options. Now, as we kind of get to the point of wrapping up, I want to take a look and see what let's not do it there. Let's do it on the monitor tab. Let's see how much more time has decayed on these options that expire tomorrow. Oh, interesting. Our 120 call spread, well, that's not the call spread. 190 is what we got on our call spread. It's down 160, 170, so not as much as before, right? We'd put that at 170. And then on the put spread here, we brought in $1.20. Look at that, it's back to $1.20. All right, we do have some time decay. Sometimes we'll see it on both legs. Okay, we'll see it visibly show. And a lot of times that happens if it just stays in a really narrow trading range, which, because it's similar to what we sold it for 2 hours ago, is probably quite likely. And so we've just been able to see a little bit of time decay. Had we run this first thing in the morning today, had I thought of that, we would probably have seen a lot more time decay. All right. Chris thinks maybe the 16 delta ought to be about right. Okay, could be. Now, a lot of you have been here. I think you're subscribers to our Trader Talks channel, where you can find our content really easily, right? So if you haven't joined that club yet, I invite you to join the club. Click on that little blue YouTube logo at the bottom right of my graph, or my Thinkorswim that you're seeing here, and that will subscribe you to the channel. Now, you only need to do it once. After you do it, you're in like Flynn. That's probably a really old saying, huh? And let's go to, I wanted to show you what it looks like. And I think I'm picking the wrong one. Let's try it this way. Let's go here. No, yeah, I think this is the right one. When you're in the Trader Talks channel, then you can see our playlists. You see a playlist for this particular class. You'll see Ben's face here. Look for Ben's face. If we look for Ben's face, we will see index options. They'll be down here somewhere. I think maybe the fastest way here, actually, I should have clicked on playlists so we could go find that playlist as opposed to these other groupings that we've formed here as well. So I invite you to join the channel so you can find our content so much easier. Follow Barb and I on X, Connie Hill CS, Barb Armstrong CS. And then if this was helpful to you today, we didn't have a survey, but if this was helpful to you today, go ahead and hit the like button on your way out. So we have a lot of good content, lots of places for you to explore. Barb, thank you for helping me out in the chat today. Thank you, everybody that was here. Appreciate your participation and helping me know what the right moving average was to use here. Sounds good. Now, coming up next, this is a little bit more of an advanced class. Coming up next is more of a beginner class. And you can see, I'll show you here on our Trader Talks, next up is stock investing for beginners. Okay, Scott Thompson does that class. Even those of you that are maybe a little bit more veterans of the market can still get a lot of value out of a class, even though it's geared to those that are new to the market. So have a great afternoon. Scott will be there right at the top of the hour. Thanks, everyone. Bye-bye.